It is the end of the year, so there's a lot to unpack with year-end tax planning to hit a few deadlines by December 31st. Joining us now is Jamie Golombek, Tax and Estate Planning Managing Director at CIBC Private Wealth. Jamie, thanks as always for joining us.
My pleasure.
Okay, we've got about 2 weeks. What is it? A little over 2 weeks to go. What, if you're waiting, what should you be doing? What's the first thing you should be doing right now?
Well, we always talk about, the end of the year tax loss selling. You have a deadline of December 30th that settle that trade by December 31st. And you would do this, you have, the odd loser in the portfolio. You don't think it's going to bounce back. And you want to be able to use that capital loss against any other gains this year. But it's also your last kick at the can to go back 3 years. So you can take capital loss, apply it against capital gains in the prior 3 calendar years. And so 2022 falls off the table. So I would just take a quick peek at your 2022 tax return. If you reported any capital gains there, maybe now you want to realize that loser before the end of the year, take that loss, carry it back to 2022, and get back any capital gains tax paid in that year.
And how many do you sell? What do you base that decision on when you're looking at your loss at the investments that aren't doing well? Do you hold on to some? Or how do you make that decision?
Yeah, so I think primarily you want to make sure it's an investment decision. In other words, you don't want the tax to drive it. At the same time, tax could be a consideration. So I'd look at your portfolio and say, these particular stocks, these positions, I think I'm done. I think I could better deploy these assets somewhere else in a different stock or a different position. I can rebalance the portfolio, time to take those losses. In terms of the quantity and quantum of those losses, then you really want to be strategic. Do I have other gains this year, in which case I can get the capital gains tax eliminated? Do I have gains in the prior 3 calendar years? Otherwise, you don't have to sell anything else because losses carry forward indefinitely. So there's no rush to sell things from a tax perspective if you can't use the loss right away. But at the end of the day, I would say make an investment decision first. That should be your primary consideration.
Okay.
Jamie, for some investors, you talk, for high net worth individuals, stuff like that, the idea of, personal holding corporations or things like that are better to hold investments. And what are you thinking is, should it be as an individual, or are there any reasons to, put it in trust or do other forms that are, better defer the gains over a period of time or a better way to take in income as well?
Yeah, well, it's interesting. So there's a number of planning opportunities out there. I mean, the truth is that, if I was setting up a corporation today purely for investment, I probably wouldn't do it because actually investment income is taxed poorly in a corporation in all provinces. The tax rate is effectively higher. But most people, of course, have a business or they have a professional corporation. The money's already in a corporation, in which case it's expensive to take it out. So they do their investing in the corporation. There are some other strategies out there. People have used family trust, for example, on the high net worth side to do some income splitting. You've got to be careful. There's attribution rules there. One of the more popular techniques that we've been promoting over the last number of years with the decline in interest rates is to do what's called a prescribed rate loan, where let's say a parent loans funds to a family trust, charges a minimum 3% rate. Any rate of return above that can then be taxable out to the beneficiaries. Typically, these would be children and other family members. So there are some more sophisticated strategies out there involving family trust. But, for the average person, investing in a non-registered portfolio to the extent that you've used up all of your RSP and TFSA room is probably the way to go in a basic non-registered trading account.
All right, and let's talk a little bit about TFSAs. What's the best way to approach those if you've got some room or you might want some money from it?
Yeah, so again, one of the things we're telling people is between now and the end of the year, if you think that you need to tap into your TFSA for any reason, because TFSAs are a general purpose investment account that you can use for anything from a new car to a new roof or an emergency fund. The nice thing is that if you need money, let's say earlier next year, take it out this year. And the reason we suggest that is because you're allowed to recontribute any withdrawals beginning the following calendar year. So let's say you need to take $10,000 out in February for some reason. Take it out in December, because if you take it out in December, I'll have it for February. But then should you have some extra cash anytime in 2026, you'll be able to recontribute it immediately back to the TFSA. If on the other hand, you wait till February when you actually need the money and you take the $10,000 out, you're not allowed to recontribute that until the following calendar year, 2027.
I got another one, Jamie, more as a personal thing, because I turned 70 in January, and I have to, I guess, roll out of my RSP. Do you suggest most people sort of go into RIF the same way, or annuities, or what are the options? Because I guess if you take it all out, it's all taxable at that point.
Well, that's right. So you have to convert your RSP by the end of the year that you turn 71. And you've got three options. Of course, you can cash it in and pay tax, which no one wants to do. I think rarely do people take that option. The most common option is the RIF. The RIF is a continuation of the RSP, but it's in reverse. A RIF requires you to take out a minimum amount, starting at around 5%, going all the way up to 20%, depending on your age, of the fair value every single year. There's also another option, a registered annuity. Some people do both. They want a guaranteed flow of income, so they'll put part of that money into a registered annuity. But I'd say most of our clients want the flexibility that comes with the RIF that allows them to choose the investments inside that account and then take out the minimum. Of course, you could take out more than minimum, but the minimum amount every single year. And of course, you pay tax on that on an annual basis starting after age 71.
Okay, we're going to go the other way because I'm a young student, unlike John. And let's talk about what should we be aware of for the end of the year for students?
Yeah, so a couple of things. Students, we often recommend the RESP, the Registered Education Savings Plan. Parents want to make sure, grandparents that are topping up $2,500 a year for every single student to get the Canada Education 20% match. That's $500 per year per child in RESP. But I would also say before the end of the year, if the students are already in post-secondary education, you might want to be strategic about RESP withdrawals. The withdrawals, other than the contributions, are taxable to the student. But remember, each student, each individual in Canada gets a basic personal amount, which is over $16,000. So this is an opportunity to withdraw $16,000 of educational assistance payments per student each year to soak up that basic tax credit. So if someone has no other source of income, they don't have a lot of income from either a summer job or a part-time job, in the next couple of weeks of the year, take a look at the student's projected 2025 income, see if there's an opportunity to take out extra money from the RESP that'll help pay for some of their post-secondary education expenses this year.
Okay, that's good advice. My son is starting college in January. Jamie, thank you for that last piece. All right, thank you very much for joining us, Jamie. We appreciate it.
My pleasure.
Jamie Golombek is a tax and estate planning managing director at CIBC Private Wealth.